Let's come to probably the last of these stories. The recent global financial crisis started end of 2007 in the US, somewhere in October. In India, we started feeling the repercussions after about 2-3 months later, January of 2008. Another totally mad kind of a boom, with its underlying asset being not tech but real estate. The US experienced a real estate boom from the early 1980s to the latter half of 2007. Interest rates were progressively lowered right down to 0.5% in an attempt to combat the recession of 2000 to 2003 following the tech bubble. This is a beautiful case of how one crisis lays the foundation for the next crisis. The tech bubble led to a contraction of the economies, and to rescue the economies, the techniques of John Maynard Keynes were used by the governments, and one of those techniques was to keep lowering interest rates, because when you have a economic crisis, a financial crisis, the first thing that happens is that economic activity shrinks. There are job losses. That leads to less money in people's hands because we are not earning our salaries or wages. Less income means less spending. Less spending means less demands for goods and services. Less demand for goods and services means lower corporate profits, or we can say losses. Production levels shrink. What happens now is, the moment production shrinks, what do? You start downsizing. You close some factories. You close some offices. You lay off people. So it's a vicious cycle. So the more you lay off, the less people are going to earn. Okay, people stop lending to each other. Banks cut down on lending. People take less housing loans. Less demand for real estate. Now promoters are affected. So every link of the chain, you have contraction. So this is a hallmark of a recession. And the contraction is much more severe in a depression. Now the governments, in the wake of the lessons that they learned from the Great Depression of 1929 to 1932, started using the techniques of John Maynard Keynes. Don't sit on the fences and allow people to go bankrupt. There's a lot of misery that the poor people will face. So come to their rescue by injecting liquidity into the market. How do you inject liquidity into the market? You can increase money supply. That is on the one hand. The second hand is you can make finance cheaper, so that people make greater use of finance, avail of finance more. Now, the cost of finance is always in the interest rate. So the lower the interest rate, the cheaper finance is. I, in the US, would not have taken a housing loan if it was a 5% interest. But at 2%, I may be tempted to take. So they cut down the interest rates right down to 0.5%, which means that loans would be available between 1 and 2%. And this was to correct the economy because of the tech bubble. Now, somehow by 2003, 2004, we had got over the tech bubble pain. Some markets started rising again, including in the Indian market from 2003 to 2007, we had a tremendous boom. In the US, there was a boom, but the boom was in real estate. So here you have a beautiful situation, very low interest rates. Already there's an ongoing boom in real estate. Now the low interest rates enable people to borrow money and further invest in real estate. Prices go up even more, and the boom continues. Lower interest rates affected bank profitability adversely. Lower profitability meant lower bonuses and pay packages for banking executives. Warren Buffett says, in looking for people to hire, you look for 3 qualities: integrity, intelligence, and energy. And if they don't have the first, the other 2 will kill you. If they don't have integrity, all their intelligence and energy is going to kill you. This is exactly what happened in the global financial crisis. Bank executives' pay is coming down, banking opportunities are coming down, economy is contracting. How do we increase profitability? If we can't do it by fair means, let us explore the foul means. This was the whole situation. So how did they do it? Subprime lending was resorted to in order to increase profitability. Give loans to unworthy borrowers. Give loans to people who cannot repay. You know that they cannot repay. You are still giving them loans. On the balance sheet, your disbursements are growing. The amount of interest, however low it is accounted for as an income, and your business and your balance sheet seems to be expanding. Several opinions were expressed that real estate prices would never come down. This happens in every boom. Classic case was in India. Ever since independence, if you study the Indian real estate market, in normal booms in real estate, we have had several of them. In normal booms, prices have gone up about from absolute bottom to absolute peak about 5 times. Call it a boom. This happens once in 10 years, 12 years, or even more than that. But if you see the period between 2003 and 2013, prices did not go up 5 times. In that 10-year period, they went up 10 times. Okay, so well above normal. And nobody had any learned arguments for the first 6, 7, 8 years. But as the boom was ending, nobody knew in advance that the boom is ending. So we are talking about if the boom ended in the latter half of 2013, in 2012 and in early 2013, people are giving you very learned arguments about how real estate prices after this in India will never come down. They'll only go up, and that the population is increasing and this is happening. But population has been increasing since independence. Okay, and despite that we have seen the real estate is also part of a real estate market. And the moment you say there's a market, it is subject to the laws of markets. And the laws of markets are, maybe there's only one law of the markets. They go up and down. There are booms and recessions. Nobody was willing to accept those arguments. In fact, once the prices would go up no further, that means we are talking about 2014, prices failed to go up further. People were in denial, especially all the promoters were, no, this is only a minor breather, market is going up again. 2015, now we are almost finishing 2 years, reality sets in when we are holding inventories, hundreds if not thousands of unsold apartments. Only a genuine buyer is turning up. Genuine buyers don't move markets. It's the speculators who move markets both ways. Now nobody is turning up. Now we are caught. This side we have got our overheads, we have borrowed, we have to pay interest. 1 or 2 builders tottered. As you know, leading builders today are in jail, especially in North India. They have failed to deliver what they promised. That will probably bring us to a discussion about when we come to real estate, how foolish it is to buy any project that has not been completed. When you buy a project that is ongoing, like some groundbreaking ceremony is over, project will take 3 years to complete. You are buying it now. What are you buying? You are buying a promise, not an asset. That's all. You are paying good money because the builder promises to give it to you. Versus, even if you want to buy a so-called brand new flat, okay, a flat is brand new even within the first 1 year. So look for something that is totally completed, where people have started occupying, where there's an occupancy certificate. Probably half the buildings anywhere in India do not have an occupancy certificate. You can check those things out. You can check how many people are living there. Okay, what the facilities are in a completed thing. Then when you buy the asset, you are buying an actual asset. You are not buying a promise that I am in month number 3, apartment will be given to you in month number 36. From 3 to 36, it's only a promise. The promise can be broken. 36 months later, you may only have a court case. You may not have an apartment. So this is a foolishness when we go into things like this. Also, companies like AIG guaranteed against defaults on mortgages through collateralized debt swaps, CDS as they were called, also called collateralized debt obligations or CDOs. These were derivative products, complicated products, but in short, what they did was they would lump together a number of mortgages. After lumping together a number of mortgages, they would divide that whole group of mortgages into 4 or 5 parts and assign them ratings. One part of the mortgages are very, very safe. They come from government officers, other people whose salary is not in doubt. It will keep on coming very clearly every month. So these people are not likely to default on their savings. So they get the AAA rating. Then the next, some leading companies and others, those people have taken mortgages, they get the AA rating. And so on till you actually come to subprime. But there are buyers even for that. It's like selling junk bonds. So all this kind of thing was done, and AIG, a top insurance company, guaranteed these bonds. So now you look at the situation. I am heading a bank. I am merrily giving subprime loans. In the annual general meeting of my company, a shareholder stands up and asks, yes, on your balance sheet and in your profit and loss account, you are showing very good profits. You are showing good business. You are showing loans disbursed right and left. But I see that these loans are dangerous loans. You are giving some maid or some clerk or some lift person a loan to buy a $200,000 apartment. How safe is this? Aren't you endangering the company? Right now you'll show that income accrued is so much, and you'll be showing it in the balance sheet and even paying us dividends based on that. But what if these people do not pay? What if they default? What happens to our company then? And you have your answer ready. Sorry, no danger at all, because all these subprime loans have been insured, and insured by the top American insurance companies. If the people default in paying, you have to just file an insurance claim. And that is with people like AIG. So the moment people hear those brand names, they settle, oh, okay, it's all insured, it's all taken care of, it's all risk managed. Fine. Real estate became false estate when the boom ended in the latter half of 2007. Interest rates were also raised to control inflation in the US. See, just as there you had two beautiful things, real estate boom, low interest rates. Now the whole thing swings the other side. Interest rates are going to be raised, and the real estate boom starts getting shaky. Interest rates increased in stages from 0.5% to 5.25% ultimately. Most subprime mortgages were floating rate loans. They will float as the rates go up. There were huge defaults as borrowers could not meet increased payments because they were financially unsound borrowers in the first place. We give loan to unworthy borrowers, now we bear the risk. Increased interest rates, subprime mortgage defaults, and crashing real estate prices coming together were a recipe for disaster. Sales of real estate belonging to defaulters sent real estate prices down even faster. You can't pay, bank takes over property. We are adding to already the supply in the real estate market. Banks could not recover the principal amounts of mortgages, forget about interest. Now comes the role of leverage. Most banks had leveraged their capital to outrageous levels. That means for every 1 rupee capital you take, you have got 10 rupees or 15 rupees or even more of borrowings. Lehman Brothers was leveraged 35 times its capital. People are wondering why it failed. 35 times its capital. That means 3% of loan losses would wipe out its entire capital. Somebody defaults to the extent of, let's say 97% people pay, 3% default, your capital is gone. You're a company without capital because you're leveraged that much. The losses were so great that banks started defaulting on their borrowings. So they started resorting to claims on CDOs, which are supposed to insure debt holders against default. Now what happened? They started queuing before AIG. Insurance claim. The magnitude of the problem was so great that even insurance giants like AIG suddenly looked like pygmies. Okay, the whole insurance industry is based upon the theory of probability. And the theory of probability is that you insure against bad things happening to a diverse set of insurance purchasers across diverse geographies. Even if one city is hit by an earthquake, and there are a lot of earthquake claims there, you have also issued 1 million other people in 1 million other cities where there are no earthquakes at the moment, and therefore your problem is only there. But here, such an amount of insurance had been given on the probability that these kind of defaults would not take place. So if all the people of the insurance company now start queuing up and putting their claims, then the insurance company itself needs insurance. Okay, this was the disaster that happened. One of the first victims outside the US was the British bank Northern Rock in August 2007. It had insured heavily in these kind of products, CDOs, CDSs. The interest on those things was not coming in, principal was not coming in. They went to AIG or whichever insurer threw up its hand, sorry, we are ourselves going bankrupt. Northern Rock failed. And then you had a huge number of defaults thereafter, huge number of defaults. These are some of the very big names in finance, and if you see the last two there, they are the nicknames for it, but they were semi-government companies. Semi-government companies actually floated by the US government to help people acquire houses by taking loans. So these two are still in existence. The others have all virtually closed up. And here were the very, very big names, very big names. Every one of these people, most of them closed up. One or two have survived, like Goldman Sachs, AIG only because of the US government coming to its rescue. Like I said, you had technology jokes, you had also global financial crisis jokes, which you can read. The Great Depression of 1929, which has been the worst ever depression in economic history, and the global financial crisis following that after about 70 years, we don't seem to have learnt much. The second worst. So we have in recent times lived through the second worst economic crisis that we have seen. Both essentially were credit contraction problems. And credit contraction takes place when leading financial institutions suspect each other's health so much and suffer from poor health themselves that they close down all lending operations. There is a crisis of confidence, a trust deficit. I kept on issuing bonds based on subprime mortgages because I believed that there's an insurance company that will come to my rescue if those bonds go into default. Okay, I was very comfortable with that arrangement. Now there is a default. I go to the insurance company. The insurance company does not honor my claim. Immediately, I ask myself, what's the use of insurance? So I was a big bank, I lent to another big bank, that big bank is going down, not able to repay me. So now it is not my, housing loan to some poor driver which is going into default, but a huge chunk of money which I lent to another large financial institution which I'm not getting back. So what do? Whatever I've got, I'll sit quietly on it. I'm not going to lend anywhere. This is called credit contraction. Okay, total confidence. I don't trust anybody any longer. So when you have things like this, the stock market will crash and especially if this kind of a problem crops up when the market is already high, at the height of a boom, then it is even worse. And many of these things happen only when there is a sufficient boom in the market. Most stock market operations are done on credit, like margin trading, and are highly leveraged using financial derivatives. So the crash can be very severe. Raghuram Rajan says, the financial sector is, if anything, innovative, even in the ways it gets into trouble. So every time you have something new, we think it's different this time. But as John Templeton said, the four most dangerous words in the English language are, this time it's different. So every time there's some new thing, for the first time it's as if there's some great invention that has come into play, and suddenly we realize that it's just old wine in a new bottle, and the whole crisis takes place again. At a birthday party for a wealthy friend in Omaha, several guests asked Warren Buffett if their money market funds were safe. Okay, so when you're worrying about a money market fund is something like what we have liquid funds in India, but even safer than that. It is supposed to be as safe as the safest investment you can think, except an investment guaranteed by the government of a country. So when people are scared about these kind of safe investments, he found the questions worrisome. They suggested widespread fears about the safety of funds long perceived to be invulnerable to losses. This is a classic case of concerns about credit. I'm now concerned about it. And his saying on this was very good. When people who drive Rolls Royces are worrying about their piggy banks, you know you've got a problem. This is also in lighter vein. (1929) and 2008 were two occurrences that could have been equally disastrous. Let's take the Dow Jones Industrial Average. The Dow Jones Industrial Average fell in 1929 by 89%. And from 2007, in this crisis, the Dow Jones Industrial Average fell something like 53%. Where the magnitude of the problem was concerned, I can tell you it was more or less the same. It could have finished the whole economy. We are lucky in India because India is still insulated from the rest of the world, and in 10 years back we were even more insulated. So we did not feel it really, although the Indian markets also fell 60%, but that was a sudden sharp fall which recovered after 14 months. If you really want to see pain in the markets, the recession should last 2 to 3 years. That's when you really begin to see what a recession is. But coming back to the United States, and we are now talking about only this one index, the Dow Jones Industrial Average, roughly comparable to our BSE Sensex, because that also has 30 stocks. What was the reason for the difference in the magnitude of the fall? Or why was the pain here less than this? The only reason is that the ideas of John Maynard Keynes were employed by the governments to tackle the 2008 problem. So while we had a serious problem, the government stepped in using all the weapons at its hand, fiscal measures, monetary measures. On the fiscal side, expenditure, taxation. Increase government expenditure to kickstart the economy, because when you increase expenditure, it's going into something. Are you going to spend on infrastructure? Suddenly there are infrastructure companies that will bid, tenders will be floated, somebody will get it. That company will employ people. That company will get paid by the government. The company pays its employees. Employees start spending more, and somewhere in the economy there is a small revival. So it has a cascading effect. When employees spend on better food, the food companies in turn get profits. If they spend on better hygiene, well, the people who provide those services and products, they get a little more. So that's how you start kickstarting the economy, and these ideas were used to mitigate the problem and solve the problem. Warren Buffett says this very, very beautiful slide about bubbles. A pin lies in wait for every bubble. And when the two eventually meet, a new wave of investors learns some very old lessons. First, many in Wall Street, a community in which quality control is not prized, will sell investors anything they will buy. Second, speculation is most dangerous when it looks easiest. So, every bubble will burst. When this happens, what we have is the lessons are constant. The lessons are very old. But people coming into the world and leaving the world, there is this regular cycle going on. So, there's always the new investors who turn out to be the bakras in this. So, this is a beautiful slide by Warren Buffett. We have to realize that Wall Street, the financial services industry, is not our friend. They will sell something because they believe they can sell it. It's the flavor of the moment. It's the popular thing now. They will not stop to analyze whether this is investment or speculation, whether this is good for you or not good for you as an investor. That is why we should be in possession of some basic knowledge where what we buy and what we invest in is sound. No warning can save a people determined to grow rich suddenly. A wise person knows that wisdom is most needed when it is least heeded. I still remember a letter written by someone to a family member. This person had lost all his money and run away after following for some absolutely scatterbrained scheme. One look at the scheme and you would know it was scatterbrained. But greed blinded that person, jumped into it, lost a ton of money, owed people money, had to abscond, run away. And later when he writes to a family, the last line of that letter, I have never been able to forget. It's a very simple line. I do not know how I could have been such a fool. I do not know how I could have been such a fool. The problem here is, we realize the foolishness only after the damage has been done, not when the party is going on, not when we are part of it. At that time we believe somehow we are magically exempted from any misfortune that can happen on this. Jeremy Grantham, US investor and asset manager, was asked, "Do you think we will learn anything from this turmoil?" He was asked in the wake of the global financial crisis. His answer was a classic. He responded, "We will learn an enormous amount in the very short term, quite a bit in the medium term, and absolutely nothing in the long term. That would be the historical precedent." Our memories were always short, but thanks to our cell phones, they are getting even shorter now. Moment the global financial crisis is out, everybody is up in arms. Governments want to find out who is responsible for this. Investors who have lost money are holding demonstrations. Okay, arrest these people, throw them in jail, do this, do that. Stringent laws are passed. We had the Dodd-Frank Act, almost 1,000 pages of new regulations on banks. They hardly could do business. It was so strict. After some time, you're finding the economy is not growing. Then sometimes the political environment changes, like from Barack Obama to Donald Trump. And now things are being loosened. Okay, regulations are being loosened. So what you are doing is exactly this. In 2008, 9, 10, you learnt a huge amount. Another 5 years passes, 6 years passes, a US president changes, your amount of learning, or I would say instead of learning, remembrance decreases. Until now, you are ready to loosen the regulations. It's already happening. You are losing the regulations which were put in place precisely to prevent future global financial crises. In other words, you are already slowly preparing the stage for the next global financial crisis. So, a beautiful saying. He really hit the nail on the head. In the long run, we have the historical precedent is we learn absolutely nothing. The concept that all useful information has already been factored into the price of a stock and that analysis is therefore futile is known as the efficient markets hypothesis. Although far from perfect, EMH has withstood a host of challenges from those who think that actively picking stocks has value. Malkiel's theory that the course of stock prices is like the random walk of a drunkard is derived from EMH. It's called the random walk theory. The internet bubble, therefore, seemed inconsistent with the view that the stock market is rational and efficient. However, the tech bubble and other stock market bubbles actually prove EMH because in every case throughout history, the market has always corrected itself. Anomalies can crop up. Markets can get irrationally optimistic or pessimistic, but eventually true value is recognized by the stock market, and this is the main lesson that investors must learn. Your return does not change. What changes is the variation around the return. Never forget this in stock market investing. You have a return and you have a variation. And it's very, very important to understand that the stock market investor does not play a zero-sum game. The stock market speculator also does not play a zero-sum game. Let's understand this very, very clearly. A speculator you have variations. At the end of the day, you'll find that if you draw the trend line of the speculator, it is losses. Now, why are there losses? Why are there losses? Let's understand that with the player of a game of chance. Like we are just sitting and playing cards, friends of us, and we have got a kitty. Kitty is 10,000 rupees. Their graph would look something like this. I win, I lose, I win, I lose. But what is ultimately going to happen to me? You'll find that the trend line and this line is the same. When this is the same, it is called a zero-sum game. Why? There are no costs. We are friends. We are just playing for entertainment. One day I win, from my pocket goes to your pocket, somebody else's pocket. One day it may come back to my pocket. It's pure chance. Pure chance. So this is a zero-sum game. This is not a zero-sum game. This is a loser's game, as Charles Ellis so beautifully put it. When you are a speculator in the market, you are playing a loser's game. That's why the title of Charles Ellis's beautiful book, there's a 2017 edition out which I want to buy, Winning the Loser's Game. Okay, so if you are just playing a game of cards for entertainment with a little money to make it interesting, it's fine. It's better than this. Now we come to the investor. Is this the graph? You'll find it is not. This is not the graph. Because in stock market investment, there is productive activity happening. There is productive activity happening. Companies manufacture products. Companies sell services. They get paid. There is a profit. There is a value. That value is shared. It is shared among the owners of the company. The owners of the company are the shareholders. You have variances. You can have sharp variance. I just drew something like this, but you can have something like very, very, very violent variations. But at the end of the day, if you draw the trend line of the investor, the trend line of the investor is not flat as in a game of chance. It slopes upwards, which means value is conveyed. Value is conveyed through dividends. Value is conveyed through upward sloping prices. In between, there could be very nasty falls. There could be equally serious and sharp rises. That's what he means by this slide. Eventually, true value is recognized by the market. And this is the main lessons that investors must learn. So let's be very clear about the difference between speculation, a game of pure chance, and investment. If you are clear about this, investing becomes child's play. That is why Benjamin Graham stated that in the final analysis, the stock market in the short term is a voting machine, and in the long term, a weighing machine. Short term, we do not know. But when you weigh, you get the value of stock market investment. Let's, for a moment, come back and focus on where we are. We are on Burton Malkiel's 3 basic points. Basic point 1, he says, is get the knowledge that you require. You can fire your investment advisor. Number 2 is that a normal person needs to focus on only 4 categories of investment: cash, bonds, common stocks, and real estate. So in common stocks, instead of telling you how to invest in the markets, that will come later, he cautions you about what are the various dangers in the market. That's what we were seeing so far, including these examples of bubbles. So now we are coming to his basic point number 2 and the 4th asset class of real estate.